You follow so many different things. Where's the best profit opportunity right now in commodities?
I think corn. Corn still's got quite a bit of upside. We take a look at the balance there, still very, very tight. And ultimately, I don't believe the market appreciates the need to ration demand.
Scott Irwin at the University of Illinois was on the show the other day. He's suggested $10 given a set of things, including the slow start to the crop. Can we get to $10 a bushel?
I think so. If you take a look at the various different constituents that eat corn, if you look at the hogs, you make money producing hogs all the way up to $10 a bushel. Livestock cattle makes money all the way up to $7.70. Ethanol is no longer going to be a component that gets destructed because of what we've seen happen on the oil front. So $10 is not out of the question, particularly if planting is delayed as it is today in the Midwest.
I love your research. I love this film that we roll here. This is great. On the Farm with Hussein Allidina. Dreaded first chart. Bring it up here. I love this chart. I got it out of your research note. Allidina considers precariously tight corn. Corn to use stocks. What is corn to use?
It's actually, it should be stocks to use. What that is
stocks to use. That's my mistake. I'm wrong. Get that up here. Hussein has just trashed me right now. Stocks to use. Okay, go.
It's inventories adjusted for demand. And if you look at that graph today, stocks to use are lower than they've ever been since the USDA started keeping records. We got this tight in 94, 95, but that was because of a drought. Today it's because of strong demand that inventories are as low as they are.
Does Washington know this, or is this like so far removed from the issues at hand?
I think they're focused on it, right? Ethanol is consuming 5 billion bushels of corn today out of our 13 billion bushel crop. So it's a pretty significant amount. We're the world's largest exporter of corn, and we only export 2 billion bushels. We got 5 going into the gas tank today.
So the equation of corn, what's the weighting of our export market? Because you're not old enough to remember this, but I remember when exports was a huge deal. Is exports a big deal now?
From the grand scheme of things, it's not. But from a corn perspective, we are the world's largest exporter by far.
Where do we export to?
We export largely to Japan, Korea, Mexico, and increasingly China as well.
Okay, this chart, I love this chart. I got goosebumps over this. Hussein sees this every day. He's bored. The white line is corn. It's an elegant chart. Wheat and soybeans bundled in there. And that is the ethanol distortion, isn't it? Is it that corn is up or the others are suppressed? I mean, what's the dynamic there?
Ethanol plays definitely a role in that price performance that we're seeing in corn. But if you take a look, you've got producers in South America that produce. Brazil, Argentina produce a lot of soybeans. Wheat is produced globally. Now, I think actually that there's a lot of upside potentially in wheat. If you look at wheat balances, from a statistical perspective, they look good. But if you take out the countries where that wheat is held, you take out China, India, Iran, that are not going to export wheat, the picture is actually much tighter. And then layer on top of that the bad weather that you have today in the U.S., where it's quite warm in some of our bigger producing states. You take a look at what's happening in Europe. France has not seen the precipitation it needs, and then you've still got uncertainty surrounding the Russian winter wheat crop. It's not clear that wheat does not perform.
I would suggest your note borders on inflammatory. Bring it up here, folks. Note of the day, very serious and wonderful research from Hussein Allidina. Ration to conserve what remains. We continue to believe that corn and soybean, they will move higher. Prices are not sufficiently rationing demand. Are you suggesting the United States of America should ration our grain crops?
I'm not at all suggesting that the U.S. should do that.
I just did that because I'm a media guy, and we're trying to get you to say outlandish things.
No, I'm aware of that.
Okay.
So no, I think you need to see the price move higher to limit demand. Today, the balance is as tight as it is. We saw the last exhibit, and yet you're still incentivizing consumption. You can't incentivize consumption when you've got uncertainty surrounding the amount of acreage that's going to get planted because of the weather. You're dependent very much on the weather in July and August as it relates to the ultimate corn yield, and you're still making money feeding hogs and cattle. This price has to go higher in order to ration demand. The market will do it.
What's the number one thing my viewers, including me, I don't even know what a bushel is. I had to have explained what a bushel was.
56 pounds.
56 pounds. Thank you. That's a fact of the week. What's the number one thing we get wrong about the manufacturing of food in America?
Well, we assume that production is going to continue to grow as it has in recent years. Corn yields have increased meaningfully owing to, advances on the technology front, the application of fertilizer, so on and so forth. But when you forecast this forward, you've got to appreciate that you can't have compound growth continue forever. There is a constraint to how much you can get out of a specific acre. And I think if you look at some of the yield data, it is getting, closer to that sort of that cap.
John Deere, Dennis Gartman today is saying farmers complaining. Here's a chart on John Deere going back a million years. I mean, this is a boom time for farmers. Do I have that right?
Oh, absolutely, absolutely. They're making, I think, quite a bit of money. The guys I talked to in the Midwest have big smiles cheek to cheek on their face. There's no doubt that they're enjoying the prices in the market today.
What would you like to see government policy do? What would be the intelligent government policy for our viewers?
I think, well, if you take a look at ethanol, we talked about how 5 billion bushels of corn is being used to produce ethanol. I don't think that there's anything wrong with that, but I do take issue slightly with this 45-cent per gallon subsidy that we're providing. There's no need to have that subsidy. If you look at where gasoline is, you look at where ethanol is, refiners and consumers of ethanol have the incentive to use it. You don't need that, $7 billion a year, I think, being spent on ethanol. And I think that you ought to open up the market to Brazilian ethanol and make it a free marketplace.
We reviewed this before. Bring it up again. Oil, ripping up the script here, folks. Forget NYMEX. Focus on Brent. We'll bring up that chart. It's an audible.
42.
There it is. It's an audible. Focus on Brent. Why do we focus on European Brent and not West Texas Intermediate NYMEX?
Well, it's only traded in Europe, right? So the only people that are consuming WTI today are the refiners that are in PAD 2 in Cushing, Oklahoma. Refiners on PAD 1 on the East Coast here, they're consuming a Brent-linked price. WTI is depressed because it's landlocked. My colleague Evan Callio and I wrote a pretty intensive note on this. That situation there is very unique. It's landlocked, and that'll correct itself over a period of time, but everyone else is paying a Brent price. You and I are paying a Brent price for crude. The world is paying a waterborne price.
Bring back this chart. I want to see this oil chart again, if you would, Rex. Victor back from an 8-week vacation. Our camera crew, I don't know what it's like. I don't even get it here. I mean, I don't understand how the camera guys get 8-week vacation. There they are. Look at the tan on him. He's styling. My word. Okay, back to the chart here. Forget NYMEX. Focus on Brent. Are we going to see a stochastic pointy type 2008, or is there going to be a persistency here in oil and in other commodities?
If you look at the fundamentals in the oil market right now, despite the move higher in price, demand is still very firm. And I think that's the important thing. People today are focused on the supply side, which is fair given what's happening in the Middle East, but demand, despite the rally we've seen, is still firm. The reason we saw the spike back in 2008 is because you had to ration demand and you had a tightness on the product front. Today, the market is very different. If you were to see a supply-side disruption, an incremental supply-side disruption, Tom, I think then you would see prices spike as they did. Today, spare capacity, 4 million barrels per day. It's not great. The market will tighten as demand grows. If I lose production anywhere else in the world, that's when you see the upside really come through.
Long ago and far away, diesel was cheaper than a gallon of gas. Now diesel's more. Why is diesel more now?
Well, it has largely to do with what's happened on the refining side. The industrialization of the emerging market is very diesel intensive. Chinese demand, we look at it, total demand 9 million barrels per day. Of that, 3 to 4 is diesel, 1.5 is gasoline.
Amazing.
The growth in the EM is diesel intensive.
Diesel.
Absolutely. That's the fuel of globalization.
Gold, elegant chart 3, bring it up here. We look at all the commodities with Hussein Allidina. The pure play versus the industrial. Platinum's the industrial, and there's that just persistent rise in gold. What a spread differential versus what we saw in 2007 or so. What's going to happen? Is gold going to come down, or is platinum going to come up, or do we stay with that differential?
So, I think the reason gold performs or has been outperforming is because of this fear surrounding inflation. We're talking about increased oil prices, increased food prices. That's going to slow growth, and that's going to be good for inflation. That is going to benefit, I believe, gold prices. If you've got the view that the economy, as our economists at Morgan Stanley do, 4.2% global GDP growth this year, 4.6% next year, then platinum does well as well, owing to the automotive sector and the strong demand there.
You have an outlier economic call. I would suggest a higher rate regime, Jim Caron, off of higher core CPI. It's ahead of commodities. How do you pull in their outlier economic call? Do you go with it word for word? Do you amend it? Steve Roach used to have them fighting like cats and dogs.
We run scenarios. Our guys are quite good. They actually were, I think, the best last year in forecasting a host of the numbers on the street. But I run a couple of different scenarios because no one can get this perfect. And despite the fact that they're really good, I'll run 4.2, I'll run 3.8, 3.6, so on and so forth. Joachimfels and his team actually published a note last week looking at what would happen if the oil price stayed at 140.
Exactly.
And what that meant for growth. So that was a number sub 4, 3.6, 3.7%. So I run that scenario as well. So it's a very iterative process, and we do battle on a regular basis.
Folks, this is really important that you understand this. Most houses have one call. Steve Roach invented economics at Morgan Stanley and said it's okay if Joachim Fels over in Europe doesn't agree with David Greenlaw over in the United States, and nobody agrees with Gerard Minack down in Sydney. He's just a nutcase.
He's a good guy. He's a good guy.
He's sat here as well. But when you fold this in, how do you fold in China GDP growth given that set of opinions?
Ching Wang is top on. I've used his number since I've been at Morgan Stanley now since 2006, and he's got it right all the time.
Is he sub 10% GDP?
I think he's just shy of 10. Just shy.
Should politicians in Washington blame China for our commodity dynamics, or like Barry Eichengreen on the dollar, this is our problem and we got to solve it?
There's a limited amount of resources, and now people are consuming it. It used to be just the OECD. Today, you look at oil demand, over half of the world's oil demand is non-OECD. The growth in oil demand that we've seen in the last 5 years has been almost entirely non-OECD. Limited number of resources, more people consuming, prices go higher. It's very simple.
Wheat in northern Africa, Tunisia, maybe that was a catalyst for the protests, and we've gone across the different nations. When do we see food protests in the United States? Maybe it's a quiet protest, but are we anywhere near the outrage over food inflation? 90-day annualized was 7.5%.
It's a very tough question to answer, but what I would say is that food as a component of our CPI is a fraction of what it is in a place like Tunisia or in the EM, where it's 30 to 40%. It's less than 10% here. Now, you are seeing companies that we meet with in our day-to-day risk management, they're complaining about the increase that you're seeing. That'll get passed, I think, onto the end consumer over a period of time. I don't know that you see protests per se, because it is a much lower component of our overall spend.
I want to bring up dreaded first chart again. See if you can do that, William. I know I'm calling them audible here. Here it is. Allidina considers a precariously tight corn. It's a redux dreaded first chart. Stocks to use. This is true across too many commodities, isn't it? It's not just corn.
Yeah, if you look at sugar, for instance, sugar inventories are tighter than they've been in a very long time. Cotton inventories, tightest that they've been in over 40 years. Now, sugar and cotton, that has partially to do with supply-side disruptions. A lot of the economists that we talk to, they're not concerned about food prices because they argue it's because of supply-side disruptions.
Going, yeah.
Last year's corn yield was the third best that we've ever had in the U.S.
And we're still short.
We're still precariously tight. So I think that, you've got to take a look at it on an independent basis. Corn is tight. Sugar should get softer.
20 seconds. Should Ben Bernanke worry about top-line commodity-driven inflation or corn?
I pay for food and I pay for gasoline. I paid $125 this weekend to fill up my car, so I'm worrying about the top line.
Hussein Allidina, Morgan Stanley, thank you so much.